Hey, Michael, how are you?
I'm
Waiting to
good.
hear
I'm just
from
trying
you.
to unmute myself.
Oh, okay. I could hear you.
Okay, great.
All right. So, what's new with you? Happy New Year. I know it's March, but I haven't talked to you. How's the year going for you so far?
A little rougher than I would like,
Okay.
but
Yeah. All right. So
but
what's on
it's not
what's
too
on the
bad.
yeah, so what's on the docket? What's your take on where we're at? Do you think the market's going to care about what Jerome Powell says? Because it seems like the market has a mind of its own anyway. That he's the market's leading Powell, isn't it?
Um, yeah, I mean, I was listening to your call for the last half hour or so, and um, I think it's basically the equity market is just uh trading for the most part like a credit spread, and right now you're seeing, credit spreads really narrow, and essentially you have, the equity market sort of reflecting that tightness in the credit market in terms of, high yield debt trading at really tight spreads to treasuries and such. And
Yeah.
so that's creating this sort of risk on like mentality in the marketplace at this moment. And, essentially you saw credit spreads just totally break down right around the December FOMC meeting when the Fed sort of acknowledged that they would be cutting rates this year, which I think was a huge mistake on their part. They should have probably waited until March to do something like that. That would have bought them some more time and it would have given them some more opportunity to see if inflation is actually on the right path, because a lot of data points that I'm seeing show that it's kind of stuck here, uh,
Okay.
right
So
above
once
this.
you release those animal spirits, it's hard to get them back in the bottle.
Right, and so I'm hoping that, although I read the text already, he kind of reiterated the same thing that he has been saying now for multiple times, and it's not really that it's falling on deaf ears. It's that we haven't really gotten a data point consistent enough at this point to get the bond market to see rates break out to the upside. I think we need 10-year rates to get above this 435 level
Yeah.
to really see that those credit spreads start to contract, to widen again, rather, and to see the market really worry about a Fed having to stay tighter for longer and the odds of a rate cut coming this year diminished. You get a hot job report Friday, and you get that followed by a 0.4% month over month increase in CPI for February. And that could very well be the trigger that sort of buries the hopes of even a June or July rate cut. Um, and I think that's really what's needed at this point to sort of reverse things in this market.
Okay. Do you see the cracks in things like Apple, Google, yesterday, Microsoft? Especially Apple and Microsoft being the two large, biggest companies uh, out there,
Yeah,
market cap wise.
yeah. I mean, basically, I don't. When I look at this rally, I keep hearing about how it's broadening out, and I don't really know what data points people are looking at when they come up with that assertion, because the data points I'm mostly seeing is how it's narrowing. And it's narrowed down to just one stock at this point, Nvidia. And
Yeah.
so, the odd thing about yesterday was that, you saw basically 6 out of the 7 stocks in the group get hammered, and Nvidia was actually up on the day.
Yeah.
And all that is really just option mania every day in Nvidia. 850 is a big level in the options market for it, and as long as that level continues to hold, it's going to be really tough, I think, to break the equity market, because Nvidia is sort of keeping things. I mean, let's face facts. Nvidia going up 6% a day is going to offset any declines you're going to see in Apple of 1 or 2%. And so that's sort of one of the big issues here, right? Is that financial conditions right now are so easy, right? That and credit spreads are so narrow that you're not seeing implied volatility moving up. And because implied volatility is not moving up, the cost of trading options is not getting any more expensive, and it's allowing this whole sort of frenzy like animal spirit environment to persist. And it's interesting because I've been sort of bearish on the Canadian dollar as well, thinking it's going to get back up to that upper end of the range, 130, 137 or so. And I've been looking for the Mexican peso to sort of put in a bottom here and turn the other way and start going back up towards the 18 to
Yeah.
19
And
area. And it
and
just
it's
hasn't
not.
happened yet.
Yeah.
Right. And,
Yeah.
so watching those two things also is because the Canadian dollar is highly correlated to changes in the VIX. And so and it makes sense when you think about it from a financial condition standpoint, because a stronger dollar is usually associated with higher with tighter financial conditions, and tighter financial conditions usually lead to a higher implied volatility level. And a stronger dollar also in the Mexican peso, it would certainly also, the Mexican peso has been basically tied to, if you invert the S&P 500, the
Yeah.
Mexican peso is basically tied to the S&P 500. It's just a risk on gauge.
Yeah.
And essentially, if you get the dollar strengthening, it should also help to tighten financial conditions. And essentially, you've seen rates and the dollar just stall out over the last couple of weeks. And so that's why the equity markets continued to have this risk on like mentality. And,
What do you
I
think
don't,
would generate a dollar rally? I had 103.80 in Dixie as an important closing level for me. And the signal was yesterday, it closed under 103.80 for the first time. And we're a bit lower again today. But, uh, my gut tells me that I don't really see the dollar falling apart here either, because I still think there'll be, like what you're talking about, potentially a USD MEX rally and another break in commodity currencies.
I'll
So,
share, I'll
uh,
share my
so
screen really
yeah,
quickly. I
okay,
mean, this is what my chart looks like on the DXY.
yeah, it
And
looks
this
like it
is
wants to go lower and further ease financial conditions.
it kind of looks like it, but you can also see this is a big area of support in here.
Yeah,
So
eh,
it depends. I mean, do we
yeah,
hold this area and do we
yeah,
bounce? Um, that's the whole key. I mean, obviously, um, if you get the dollar breaking down and rates going lower, it's going to be hard to really contain stock prices. I mean, it's really just that I think unless the market starts picking up on something else, right, which would be that of a recession or something, or a major economic slowing, which
yeah,
would be the opposite. But I don't think that the dollar or rates are in a position right now that suggests either or. I mean, you would need to really see 10-year rates break below 380, and you would need to see the dollar probably get below 100 before you start thinking about it being a risk off signal, right? Where the equity market is, where the bond and currency market are sort of thinking about a bigger risk economically here for the country, for the U.S. And
hmm
by then the
yeah,
S&P 500 could be at 5,600. I mean, so um, I mean, essentially at this point, there are certainly divergent signs. I mean, when you look at the dollar versus the franc, it looks like it wants to go to 90 cents. Um, when you look at Canada versus, I mean, this is an important level right here with a break leading to a move back to 139. I mean, we have the Bank of Canada at 10 a.m., which is really going to be the most interesting, I think, of the two, which could even cloud the message, right, around what Powell is saying. Because if the Bank of
right,
Canada comes out and I mean, and their economy has been certainly weakening at a faster clip than the US. So for if some reason they were to come out and be more dovish, and you were to see the Canadian dollar break higher, that could lead to the dollar strengthening, leading to higher
yeah.
VIX, leading to a sell-off in equity. So this is just a weird spot. And I think at this point, trying to it looks like the market could honestly break either way. That's
All
how.
right, so we're in an I don't know environment, coin flip, awaiting confirmation of direction,
Yeah,
which
I
makes
mean,
it
you need
hard to talk
confirmation at
about.
this point. I mean, generally speaking, when you look at the economic data, it would suggest that 10-year rates should be going higher, and they're not. And I don't and that doesn't really make me feel good.
Okay, so yeah, that 420 was important. If you put up the yield chart and you don't have a bias, and we all have biases,
Right.
that it almost looks like you had, very directional decline from 5%. And this looks corrective. We didn't even get to 50%. Well, I think 440 was 50%.
Yeah, I mean,
And
you're
we,
sort of like got into no man's land, to be
yeah,
honest. It doesn't really make for a nice place for it to really have stopped.
yeah,
From when you look at it from an Elliott, sort of Fibonacci sort of standpoint.
yeah,
But you're right. I mean, this certainly looks more impulsive, and this certainly looks more corrective, I guess.
yeah,
Um, but you could also make an argument that this was corrective off of this rally too. Going
correct. Yeah, you
higher,
can. So, I do have on yields, I think the 200-day is coming in right around the lows here that we've had.
It's possible. I
And
don't.
and then I wanted to ask you about the Dow. So the Dow doesn't have Nvidia in it.
Right.
That why it's been weaker than the rest?
Yeah, I mean, I did an analysis. I've been doing these little side analysis on like different on the different indices, and the Dow doesn't have Nvidia, so I think it's more reflective of what the actual market is at this point than what you're seeing in the S&P 500. I think the S&P 500 has just become another sort of arm of the of the Nasdaq. I mean, since you can see basically since December 15th, the Dow is up a big 4%, and since December 15th, you have I guess back here, you have the S&P up almost 8, right? And that
Yeah,
4% delta is Nvidia basically,
right.
or
So
that,
so as Nvidia goes, the market will go.
yeah, and I mean you might want to even throw in Wingstop there because for whatever reason, I found this totally odd. I mean, I did an analysis on this, and I mean, look at how much the stock
Wow,
has to go back to just to get to where it was on November 1st,
it's amazing.
right? It has to go down 54% just to get to back to where it was on October 30th. And it
Right.
has to go down at this point 20% just to get back to where it was when it reported results on February 20th. I mean, that in
Yeah.
itself would wipe out, 2 percentage points off the S&P probably.
Yeah. Yeah.
But
Interesting.
what's interesting is when you take Wingstop, which has nothing to do with GPUs. I mean, the charts are identical. They went from being inverse to being correlated. Basically starting right around October 31st, which of course was when our friend in the Treasury Department, sort of changed the QRA and the way that they were going to issue treasuries. If you remember, that's what sparked the sell-off that's what sparked the buying in the
Yeah.
in the rate complex, and that's what sparked the move higher in equities was when the 10-year basically broke lower on
Yeah.
rates after she sort of changed the way they were going to go about issuing
The,
debt.
yeah. So, do you think the bonds? I kind of think that there still could be one more dip in TLT, but they don't look bad. I mean, yeah, that was a. It looks like we couldn't even retrace 50% in TLT.
Yeah, I mean, I mean the TLT, we're just looking at basically the 10 and 30-year inverted, right?
Yeah.
So
Right.
again, you just got to get, you get below 92 and that's another story. But I mean, at
Yeah.
this point, you really haven't seen, you really haven't seen much happen. maybe there's even a bull flag for me here. I don't
Yeah,
know.
it looks like consolidation after that big run.
Yeah. I mean,
Um,
I've been sort
but
of in the
but
mindset that rates are just going to stay somewhere, on the 10-year, call it. I mean, ideally, I think rates should probably be somewhere in this 4.25 to 4.75 range in here and just kind of live in this zone. But it's, maybe that zone is really more in the 375 to 4.25 range. I don't really think that rates are going to break significantly lower because there's just not enough. The economy is still too strong, really, to warrant rates on the back of the curve moving down. And, I mean, at some point, I mean, shouldn't the yield curve steepen? I mean, I don't, this has been, I think, one of the longest. I mean, you've been doing this longer than I have, but this has to be one of the longest and deepest inversions we've had in who knows how long, right?
yeah,
Um, it's just not, it's not like normal to see a yield curve inverted for this long. Um, and and for it not to, I mean, these are previous inversions I have marked. I mean, I'm being generous here by saying that this inversion lasted 560 days when clearly it just kind of went back and forth for a while.
yeah,
um this inversion was only 336 days. This inversion was 511 days, give or take, again being sort of generous. And this one has been already now, even longer than that. So I mean, it's sort of bizarre to me. I mean, this is the longest inversion we've had, 623 days. So I mean, since 1989,
29, 29,
1989,
29.
29,
Come on, say 29.
29. Why? Because that's better.
All
I
right. So, okay, how about the longer the inversion, the bigger the consequences?
I don't know. I
Would that
hope
be,
not.
yeah, yeah.
I mean,
So that,
just because I'm bearish on the market doesn't mean that I want, a recession or something worse. Like, I
yeah,
just want, I would like to see just valuation sort of return to something that's normal,
yeah,
across the marketplace. I think that's really the key here. I mean, is like, I would love to see a bear steepener where you just saw the 10-year rise to something like 5% and the 2-year come down to maybe 480 or something,
yeah,
and just get back to something that's somewhat normal and
yeah.
not have like an economic chaos. Just have it where the Fed can just actually do its job the right way,
Could
get
that
rates
happen?
back. What?
Could it happen in this environment? Could it happen?
It could happen. I mean,
All right.
certainly the economy is strong enough, right?
Okay. Yeah.
But the market needs to cooperate. The market's not helping.
Okay.
The longer financial conditions stay easy, the bigger the risk you have of the Fed making a policy error. Because if we just look at, what the inflation swaps market is telling us, I mean, the CPI rate's expected to be at 3% come June of 23. I mean, this is a big change from where we were, a month ago. You have to move these dots over one, so this dot here is equivalent to this dot. So I mean, we've seen a 60 basis point move higher in inflation expectations in 1 month,
Yeah.
right?
Yeah.
When you look at 1 year break evens, um, I mean,
Michael, go ahead.
you've seen that these have just gone, through the roof.
Wow.
Um,
Yeah.
when you look at um, when you look at even 1 year inflation swaps, those have started going up too. And so all this is telling you that inflation is sort of reaccelerating here, and that's another reason why I would think that rates should rise and the dollar should strengthen, right?
Right. Right. Okay. Are you getting, what's the message you're getting from the move in gold?
It's certainly not deflationary. It's
Okay.
certainly not disinflationary either.
What's the message? Bitcoin and gold.
They're telling you that there's still too much liquidity in the system. Gold
Okay.
is telling you that rates should probably go higher, and Bitcoin is telling you there's just too much excess. There's still too much money in the system. Maybe that
Okay.
starts coming out next week when the bank term funding program ends.
Yeah. Yeah, I mean that chart doesn't look bad either, KRE.
The KRE?
Yeah, it doesn't look terrible.
No, it doesn't. It could be worse.
Yeah, almost looks like the bonds, the yield chart. So
Mm,
maybe that's why the inversion's still there to help these guys out.
no, I
Does it
mean,
help them?
I would think it would be the opposite.
Okay.
They really need the curve to steepen.
Okay. All right. So really the big takeaway is financial conditions are too
They're too
loose
easy.
still and may be about to get looser if the dollar
Maybe.
breaks down and yields keep heading lower.
I mean,
So
I hope that doesn't happen because I think I'm just gonna go and disappear for a while here.
well,
Because I
maybe we're
don't,
going to have a blow off to 6,000. I know some people even talking 7,000 S&Ps.
I mean, I know that there's always those risks and everything.
Yeah.
In my mind, I would just, I would probably, not want to be around for that
Okay.
because what comes afterwards would be really. I mean, you can see the financial conditions. This is over a percentage. This is I'm trying to see 1 day Z score. This is on a monthly chart, right? So this is a 1 month decline. We had the biggest easing of financial conditions since 1980, right? It
Wow.
was like the Fed already cut rates. The Fed doesn't need to cut rates. The market already pulled forward six
Yeah.
rate cuts for the Fed, basically.
Yeah. So the market, that's what I mean, is the Fed becoming less relevant than the market, that they're just following the market. And he'll adopt his message to what the market's doing. I mean, after 60 minutes, we had that bump up in yields. And since then, we've taken all of that away from his 60-minute uh,
Yeah,
appearance.
because I mean, honestly, he keeps sending out these guys and they keep saying the same thing. Oh, we're looking for rate cuts. Stop with saying you're going to have rate cuts this year.
Yeah.
The only one
We'll,
who's kind of changed the message recently is what's his name? Barkin, I think
yeah.
said that maybe there wouldn't be any if things continue. But I mean, and now you have Bostic sort of coming out saying, well, we could cut once, but then we would pause. I mean,
All right. Yeah.
you know, unfortunately, this is starting to look like could potentially turn into a repeat of the 1970s. Um,
Yeah.
I know that
Uh,
we don't have much more time left, but look at what shipping rates have done.
yeah.
I post these charts on Twitter all the time. I mean,
Yeah.
look at what shipping rates have done over the last. I mean, this is going from 1,400 to 3,400, right? That's more than a 100% move. Look at what the Baltic Dry Index is doing, right? I mean, these are good. This is going to feed into goods inflation. The only reason why we've had any disinflation at all so far
China.
is because you've had goods disinflation and you've had energy prices collapsing. But
Right.
I mean, look at the move you're having in Baltic dry freight. It's moving back up pretty aggressively.
Yeah.
Look at the price of gasoline. The average price of gasoline this month alone. I mean, it's only the sixth day of the month, and gasoline prices this month are already up, almost 4%. That's following a 4% move 4.5% move last month and another 4% this month.
And diesel has even been stronger, hasn't it? Is that the
I
blue line?
No, that's the RBOB.
Okay.
Diesel I have here too. I don't know what diesel's done.
Well,
Diesel it had a move, but it looks like it's it looks like it's getting ready to go higher
yeah,
too.
to go again.
So
Interesting. I tell you, Michael, I learn from you every time I talk to you for half an hour.
it would be
Eh,
great though if the market actually sort of traded with these things, though. It'd make my life a lot easier.
Yeah. Well, if you go away, I'll meet you on Jekyll Island. Huh? Ever read that book? It feels,
No.
oh, yeah, it's about the Fed,
Uh,
Jekyll Island. It's not Heckle and Jekyll, and you're probably too young for that cartoon
Jekyll and
anyway.
Jekyll, yeah, I remember that.
You
The two
remember that?
crows.
All right. I have a question. Does liquidity in the equity market in any support give any support for the dollar to surge? What do you
Well,
think?
they usually work in inverse of each other,
Yeah,
right?
yeah,
So I would probably say no. I
yeah,
mean, if anything, if the equity market's rising, it's probably because the dollar is falling, right? You have more of a
yeah,
risk on mentality, so you probably
yeah.
have more of a movement into those emerging market type currencies and away from the dollar.
Okay. Well, Michael, thank you so much for coming in here every quarter or so, and you have insights and wisdom that open my eyes to things that before I talked to you I wasn't paying attention to or um, knew about. So thanks for edifying the whole community. We appreciate it.
Not a problem. I always enjoy coming on with you, Dale.
And 2024 is still early in the year, and every dog has its day. That's what I say.
It's
So
true. Markets goes in cycles, and
yeah,
the pendulum always swings one way too far to the other. It's just knowing where it's
never
gonna
seen a
stop swinging.
yeah, never seen a rubber band this stretch without snapping. But we'll
I
see.
unfortunately I have. If you remember, the late '90s was very
Oh,
similar.
that's right. Yeah, I can't even remember that far back, but
I have
thanks
good
again.
memories of those times, but it was afterwards that I don't really enjoy remembering.
Yeah. Well, you know what? When it comes, you'll be there. And to be there for the good times, you have to be there all the time. So you
That's
can't
right.
take a vacation, bro. You have to
Okay,
just gut it out, and I'll talk to you later in the spring.
that sounds good
Uh,
to me.
all right, Michael Kramer, everyone. Follow him at Michael Mott CM on X. Go to his website and learn about the inner workings beneath the surface of debt and equities, and pays a lot of attention to currency action. So
I do.
check them out. Check them out for your intelligence gathering.
Thank you, Dale.
All right, buddy. That's a wrap, everyone. Don't just count your yields, count your blessings, and you could join the team in 15 minutes on the morning edge. And we'll see you tomorrow. Enjoy. Oh, Jerome Powell. He's not Paul Volcker. Is he Arthur Burns? Is he bipolar? We'll see today. Adios, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.